think finally got the Zoom to Facebook figured out. So hopefully it works. Hopefully it records this time too. Had to do the last one like 4 times. Welcome, Sabrina. Cool. All right, we'll just give it a couple more minutes for people to trickle in. If you haven't done this before, this is a monthly webinar that I give. So it kind of builds on itself from month to month so that you can just stay updated on the biggest news and trends, what's happening right now with the economy and real estate and things like that. So I think, you know, it's most beneficial if you watch it every month, right? If you just check in once a year, it's tough because I try to explain it as much as possible, but you know, sometimes that context is really helpful, right? So just something to keep in mind. If you guys got any friends that invest in real estate or just want to know more about the economy, definitely shoot this over to them as well. Definitely looking to get as many people involved in this as possible. So that would be great. All right, give it another minute or so. Welcome, Brian, Stephen. All right. Midtown, right on. Bendra, cool. All right, let's get into this. All right, I'm gonna go ahead and share my screen with you guys, and then we can get rolling. All right.
You want to hear some great news?
All right, let's get started. I'm excited. You guys pumped? It's gonna be a good week, good weekend. All right, so this is the State of the Union. So this is the monthly talk that I give on the US economy, the real estate markets, and whatever the big news and trends of the time is, right? So I'm gonna be walking you through the big picture, the macro level, and kind of just spoon feed you all this stuff that's frankly quite boring to research on our own, right? So hopefully you find some value in it. A bit about me if you're new to my content. So I'm from the Boston area originally. I went into the Air Force right out of college, so I ended up going on an aviation track. I flew the B-1 bomber for a number of years. I got about 2,500 hours in that jet, multiple deployments. And while I was active duty, I started investing in real estate. So I bought my first property. It was a duplex. I house hacked. So I had the tenant on one side, and then I had me and my roommate on the other, and I had no bills because of that, right? You know, my mortgage was paid for, my utilities were paid for. So it was really financially great. So that is what piqued my interest into real estate investing. And then a couple of years later, I bought another duplex and then so on. And then fast forward to when I got out of the Air Force a number of years later, I decided that I wanted to pursue bigger and better things. And real estate was top of mind because I still had these properties that were cash flowing every month, even though my income had disappeared from the military. So that's where I really saw the power of real estate, especially for long-term building wealth, preparing for retirement, right? So these things are important to everybody. So I think real estate is one of the best assets for that. Also invested in crypto. So I'm very bullish on crypto at the moment. I think the landscape looks really healthy. I don't want to get into a big Bitcoin discussion today, but if you want to talk about that, then certainly shoot me a message. We can talk offline for sure. But right now I'm focused on real estate with Mach 1 equity. So we're buying some commercial properties through syndication. So I raise money from private investors, people that want to invest in real estate because they see the benefit, but don't want to become landlords themselves because that's a big hassle. It's a lot of time and energy that goes into it, right? So one of my active projects right now in Loveland, Colorado is the Ganala Plaza. This is a medical office development that my partners and I are developing. And I'm excited about this. It's about 10 days from breaking ground. So that's finally moving forward. I'm excited about that. We're projecting 35 to 45% return to investors in probably about 18 months. We had about a 6-month delay due to Corona, unfortunately, but still, it's a pretty short timeline for that type of return. So I'm excited. In other news this week, I also found out my partners and I are in best and final on a 216 unit in Atlanta, Georgia. So a great submarket of Atlanta. That's a Class B property, which is exactly what you want right now, given the economic climate, which we'll talk about. And I'm excited for that. So if you're looking for opportunities, definitely reach out to me, and I'll put you on the soft commitment list. So awesome. All right, jobs. This is one of the most important topics when we talk about the economy, right? So this is kind of the backbone of any economic discussion. So last month, the September jobs report, which looks at August jobs, we created 1.4 million jobs. So a bit more than the expectation of about 1.3, but overall, when we look back to where we were back in February, we're still down like 12 million jobs, right? So even though that's a big number for a single month, we got to look at the context of the big picture. We still have a long way to go to make up ground, right? Another thing of note, the largest gain that month was in government. So we had 344,000 jobs, you can see in that chart, in government, but 328,000 of those were census workers. So those aren't really like real jobs. Those aren't long-term jobs. Those are just sort of a one-time boon, right? Retail was also one of the big ones at 250K, but overall that industry is still down 750K. So overall, you could say we added 1.1 million. I think there's an argument for that. And we still just have a lot of ground to make up. Unemployment did kick down to 8.4% from 10.2. So what's nice about that is that I think it's a nice psychological barrier to be below that 10%. So that kind of improves consumer confidence and investor confidence. But overall, it's still quite high. We were expecting 9.8% for the month. So it beat that by quite a margin. But when you look at the true rate, so there's a lot of different ways to calculate unemployment. That 8.4% does not include discouraged workers that are no longer looking for a job. There's a lot of people that say, well, there's no job for me because I'm a bartender and none of the restaurants and bars are open, right? So they don't include them in that number because they're not actively looking for work, or if somebody's just really underemployed as well. So you could say a better number might be that 14.2%. There's also like 4 million people that, like I said, like that bartender I mentioned, they're just not in the workforce right now. So it kind of gets wonky when you really start looking into it. So the bottom line is we still have a lot of people unemployed right now, and we're still in a very serious economic state. So there's been a lot of discussion lately about what type of recovery we're in. You hear a lot at the beginning. We're going to have this V-shaped recovery, right? Which means, yeah, we took this big hit initially, but we're going to recover really fast and be fine. Some people are still pushing that narrative. I think that's long gone. A lot of people now are saying we're getting a K-shaped recovery, which means it's bifurcated. So the people at the top, the 1%, the upper echelons of society, the upper middle class, they're doing good. They're arguably doing better than they were before. The stock market is really high. They've gained a lot of wealth out of this. Whereas the bottom 50% of the nation, those hourly wage earners, the working class, they're the ones that are really hurt by this recession, right? And as an investor, that concerns me. Those are the ones I actually care about. I don't care if the rich are making money because they're not renting from me, right? I want the working class to be succeeding because that's who's renting. That's the renter base, right? So I think it's really important to just keep that in mind, right? All right, so looking at unemployment claims, this also kind of backs up what I'm saying. So we still have, 25 million people collecting some sort of benefit. Continuing claims were down 980,000. So that's what's looking, that chart to the right. So that's people that have been collecting for more than 2 or 3 weeks. So they're dropping, but there's still, almost 12 million people on that. Weekly claims. So this is looking at, this chart, that's new claims filed each week. Last week, we still had 837 thousand claims. So it looks like, oh, we went from 7 million down to 837. That's great. But the problem is the record leading into this pandemic was like 600,000. And that was set back in like 82 or something. So we're still doing really bad week to week when it comes to job losses. So permanent job losses are on the rise. So we've had, 2.1 million more since February. But again, there's more coming. Layoffs are picking up. Disney just announced 28,000. The airlines today, 30, 40,000 people getting laid off. And that's just two companies. There's Raytheon, Salesforce, Bed Bath & Beyond, all these companies, MGM, 20,000, all these companies are laying off a lot of people. So it looks like things may get worse before they get better, is the bottom line. All right, looking at GDP. So we just completed Q3. We don't have the numbers yet, but it's estimated the consensus is about 25 to 35% gain in Q3. But even so, we're still going to be well below where we were at the start of this. So we're still looking like we're 2 or 3 years behind where we were in terms of GDP output. So a lot of that, what's going on in Q3, there was a bounce in retail and consumer confidence. So there was a rebound in spending, which drove a lot of that. And of course, people were coming back to work if they were shut down. Also, the Fed has had loose monetary policy, so it's been a very liquid environment for business. And then, of course, the CARES Act had a lot to do with that, sort of providing some tailwind. Q4, though, it's going to be substantially weaker. They're looking for growth of about 3.5% is kind of the consensus. And over the last couple of weeks, those consensus estimates have really been revised downward. So I think JP Morgan was looking at, or maybe it was Morgan Stanley was looking at initially like 9.5%, and they revised it down to 3.5%. So that's a combination of, we don't have any additional fiscal support, right? So it doesn't look like Congress is going to get their act together anytime soon and pass a follow-up to the CARES Act. And then also, if you're a Game of Thrones fan, winter is coming, right? In the literal sense. So all these restaurants that are doing outdoor dining and gyms that are outside in parking lots and things, some of that, they may not be able to do that in the winter months. So we could see additional pain there unless we can start bringing things inside. All right, trade. So the trade deal, this is kind of a continuing disaster. It's sort of getting back into the headlines now because of each country's trying to pull itself out of this pandemic, right? So earlier in the year, we had the phase 1 trade deal signed between us and China, and it had a number of things. It was really just part one of a larger deal that they were negotiating on, but it did have some purchasing agreements from China. They were going to purchase a certain amount of goods. They've only purchased about half of what they promised to up to this point. So they purchased 48 billion. They should be at about 100 billion at this point. So they're not following through on their end. They're also not creating the structural changes within their economy that they were supposed to. So basically what's happening is they're continuing to pump up these state-owned entities and boost their state-owned manufacturing and things like that. So they're kind of just going back to the old China, essentially. And then insult to injury, the World Trade Organization came out and they ruled that the Trump tariffs were a violation of the World Trade Organization's rules, which is especially damning because we basically wrote those rules, right? So we violated the rules that we wrote. It's kind of embarrassing. And then you just see a lot of discussion right now in the news about TikTok, Hollywood movies, the NBA, where China is sort of exerting its influence on all these US companies and US cultural things. So it's sort of heating up a bit, right? All right, shifting gears a bit. So on 1st of September, the CDC issued this sweeping eviction moratorium. So this really surprised a lot of people, kind of came out of left field. You wouldn't think the CDC would be the organization that is making housing policy. You think that would be the HUD or someone, but they granted them the authority to say, hey, you can halt evictions if you feel like it will exacerbate the existing health crisis. So they said, yeah, sure, we're going to do that, I guess. So what's different about this is as it compares to previous moratoriums is it applies to all properties across the board, not just those with federal funding. But some highlights, it's not automatic. So tenants do have to apply. They do have to make a claim that they fall under this moratorium. And that is valid through the end of the year. What happens after that is kind of anyone's guess. All right, so here's some of the responsibility on the tenant side. So in order for them to fall under this protection, they have to make these declarations, and these are made under penalty of perjury. So they're basically saying, under oath, I'm saying that these are true. So they have to say that they've used their best effort to obtain government assistance for renter housing. So, they have to show some sort of documentation for that. They have to have an income less than $99,000 or $198,000 for married couples, or were not required to report income in 2019, or received a CARES Act stimulus check. So if they meet one of those requirements, then they fall under this. They have to state that they're unable to pay full rent because of a substantial loss of income or some sort of extraordinary out-of-pocket medical expenses as a result of Corona, right? And that they're making best efforts to make timely partial payments. So even if they had a loss of income, but they still have something, they should be making partial payments, right, at the minimum. And then they would likely be left homeless or forced into a congregate living setting because they lack another available housing option that wouldn't increase their living costs. So basically, they can't find a cheaper place to live without moving into, a family housing situation or somewhere where there's going to be a bunch of people under one roof, right? So they're basically saying, yeah, I don't have any other option. I've exhausted my options. This is all that's left to me. So there is some deterrence for them bureaucratically, for sure. Some of the provisions that are more landlord friendly are that rents and payments are deferred, not waived. So this is really good. I think that's a good deterrent for people that would be looking to take advantage of this situation and basically commit fraud. It doesn't actually waive their rent. It's just deferring it. So at the end of the year, they still owe all that rent, right? Late fees and penalties still apply. So those can continue to accrue and those can be costly. You can still evict for other reasons. So if someone is violating the lease in some other way, you can still evict them for that. And it doesn't protect tenants of hotel, motel-like properties, which I think Airbnb would fall under. So someone can't just go in and squat in a motel, right? So I think there is some landlord-friendly provisions. I think the bottom line when it comes to all this is because there is a bit of a bureaucratic process, even if it's not particularly difficult or, checked by the government, verified, I guess. I think there's a lot of people that are going to look at that and just go, I don't want to bother doing that if they can actually just pay the rent. So, the people that would be defrauding it. Of course, the people that actually need it, then, that's why it's there. All right, let's look at the housing industry. So, man, housing is just unstoppable right now. This is, it's just hot. It's the only way to describe it. So basically what this comes down to is supply and demand. We have high demand and low supply. So looking at new home sales, I don't want to go through every single metric on here. You guys can read, but I'll just kind of hit the big picture and give you my 2 cents. So you can see new home sales up almost 5% month over month. That's the highest level in 14 years. And you can see the listings are down 3%. So, and this is coming on the heels. Last month, we saw even larger double-digit gains in home sales. So right now, there's just 282,000 new homes on the market. And then looking at existing homes, those are up to almost 2.5%, 10.5% year over year to a seasonal adjusted annual rate of about 6 million homes. So right now, we've got 1.5 million homes on the market, which is about 330,000 less than a year ago. So you can see where that supply is just shrinking, even though demand is really remaining constant. Median home value up month over month, 1.9%. So it's sitting at about 310,000, which is an 11.5% boost over last year. That's the national average. So wow, talk about appreciation. That's a banner year for appreciation, right? So speaking more on supply, so looking at housing starts, so these are houses that are going vertical. Those are down 5% month over month to an annualized rate of about just over 1.4 million. So it missed the forecast. So it was actually lower than what was forecasted. You can see multifamily starts took a 25% hit, but those are very volatile. Last month they had a 55% gain. So I just wanted to point that out. Whereas single family starts are up 4%, but overall it's a negative for the month. So building permits. So these aren't going vertical yet, but they're applying for the building permit. About just under 1% for the month to a seasonally adjusted rate, just under 1.5 million. So it missed the forecast slightly as well. Single family permits up, again, that about 6%, and the multifamily permits down. So one of the things that's really driving this right now is that the lending environment is really low interest rates. So we got stagnant rates around 3.1%, and that's driving a lot of demand from first-time buyers. A lot of millennials that hadn't been in the market are moving into the market right now, reaching that age of first-time home ownership. So it's driving demand. And then because of Corona, there is certainly an increase of the trend towards the suburbs. People looking for a little bit more space as well. So that's driving demand. So overall, housing is just an unstoppable beast, right? All right, so switching into commercial multifamily. So rents eked up $1 in August. So that's the second consecutive month of a gain. Year over year, they're still down 0.3%, but overall, they're pretty flat. So the lifestyle class, your class A, B plus units, those are struggling the most. They've had negative rent growth in 22 of the top 30 markets, whereas the renter by necessity, that's what RBN stands for, that's your, maybe class B, B minus, class C properties and below. Those are much more resilient just because of that demand is there. And they've only seen negative rent growth in 8 of the top 30 markets. So they're doing a little bit better. And you can see class A vacancy in that chart has climbed the most compared to B and C, right? So a bit of a divergence there. So overall, the larger markets are doing worse than the secondary and the tertiary markets. So again, it's that sort of trend of towards the suburbs a bit throughout the pandemic. So the secondary and tertiary markets, 108 of the top 132 markets beat the average for rent growth last month. So that really kind of hammers it home. You can see in that chart to the right that the vacancy, it's increased for all of them, right? Just because there's economic struggle. But again, that class A is certainly the worst, or excuse me, those gateway markets. Some other things that are benefiting them. So yeah, the greater affordability as well. So these are just generally cheaper markets, and there's a trend of people moving away from these high tax expensive markets like LA, San Francisco, New York, into these more emerging markets, if you will, right? So these popular cities like Charlotte, Phoenix, Tucson, certainly everywhere in Texas, pretty much, Austin, Dallas, where they're able to attract people from a lifestyle perspective because it's a lot cheaper, but they still offer a lot of great amenities. And they're sort of emerging tech hubs in a lot of these cities. So even smaller cities like Huntsville, Raleigh, Durham, they're attracting tech talent because they have these blossoming tech hubs or biotech hubs, right? So I think it's those markets that are really positioned to be top performers in 2021. So definitely keep a close eye on any of those smaller, more affordable markets that have an emerging tech scene within it. I think that's going to really attract a lot of talent, educated workforce to those markets. Overall, collections have been pretty steady throughout this, surprisingly. I thought we were going to see a dip in September because CARES Act had ran out, but it didn't really pan out. You can see that chart to the right. If you look to that rightmost column, 92.2% is where collections ended up by the 27th of September, which is pretty much even with August, right? But there was a noticeable increase in late payments. So by the 6th of September, only 76% had paid their rent. And you compare that to 79% in August and 81% last year. So about a 5% decline from last year. So it does look like there's some weakness starting to develop, but how far that will go is anyone's guess at this point. I think it could continue to snowball and get worse, especially as these layoffs continue to pick up. That is a big risk for multifamily. All right. And then I wanted to talk about hotels real quick, because this is what I see as the biggest opportunity coming out of this whole recession. So this is the hardest hit asset class. 1 in 4 properties are delinquent right now. So hotels are operating around 40% occupancy levels because, business travel has been devastated. People aren't traveling for vacations and things like that. So travel is just down. So hotels are taking a huge hit, and it's just not sustainable for them long term because they have a lot of operating expenses. They get a lot of staff that they got to pay. So a lot of these properties are going to come on the market for, a fraction of what they're worth. Could be 30, 50, 60 cents on the dollar. And I think if you can get an asset at a steep discount, the first year or two might be, I don't want to say a struggle because you're picking up cheaper, but you're not going to see the pre-pandemic occupancy come back immediately, but eventually it's going to come back. Businesses are going to start traveling again. There's too much money on the line. And people are going to start taking vacations again. People are already fed up with this whole pandemic thing. So I think hotels are the number one opportunity coming out of this for sure. So if you know a hotel operator, please send them my way. All right. I'm looking for partners. So, all right. I think that's going to do it for this month. That is the long and short of it. The Mach 1 report, which is really what this is built off of, that is going to be going out with the replay of this so that you'll have the PDF version of this to reference and dive into a little bit more deeply. And again, if you've got some friends, have them shoot them over to my website. Definitely looking to pick up some more people that are interested in this type of content. Next week, I'm going to be doing a follow-up to my previous webinar, which was how to analyze a rental property. Next week, I'm going to be doing how to manage a rental property. So I'm going to be taking a look at my expense tracker, my profit and loss tracker to help give you guys an idea of, once you have a rental property, how do you manage the thing, right? So I think that's going to be helpful. There's going to be a free spreadsheet along with that as well for everyone that signs up. So, all right. That is pretty much the formal part of this. So let's get into the Q&A. Is it always on the first of the month? That's a good question. So I'm in the process. I think I'm going to try to slide it to more of a mid-month. So I think the next one is tentatively scheduled for like the 3rd week of October. So I want to move it a little bit earlier and settle into a mid-month date for this. So it's just been kind of hectic the last couple times because I've got some VAs that I'm trying to help with some of this, and I've gone through a couple different people, so sometimes things get delayed or have some tech issues and stuff. So, cool. These rules can be overridden by local ordinances, moratoriums, correct? I think it depends what you mean. I think if a local statute is more strict than this, then I believe that's true. I don't think a local community can just say, yeah, we're not going to listen to the national authority on this, if that makes sense. So, Brian, I have plenty of hotel deals in the work. Reach out. I will reach out. Yeah, that is good to know. I'd like to hear more. You're welcome, Sabrina. Cool. All right. What other questions you guys have? One thing that I think is pretty interesting that's happening right now is, I don't know if you guys saw, I think it was JP Morgan just paid $1 billion fine for committing securities fraud or financial crimes. So what they were doing essentially, as I understand it, was they were putting in these large orders for securities so that it would boost, just having the order in there would boost the price or manipulate the price in some way. And then they could get a smaller order through while that price adjusted, and then they'd cancel the big order. And they did this like hundreds of thousands of times. So there's like 3 or 4 people indicted right now, but the bank had to pay $1 billion for this. And it's sort of getting reported on, but not really. I just think it's crazy the fraud that goes on at that level, and we're all just sort of at its whim. So that's another reason every time I read something like that, I just think, thank God I'm in real estate, because you never know when the shit's really going to hit the fan and we start losing money because of their fraudulence, right? And we're playing against forces in the stock market that we can't control and we can't compete against. So if these market makers, and it's clear they are manipulating the market, they're making the market. If they want to drive the price down on something, they can do that. So, that could be at our loss, right? So it kind of really sucks. Do I have other syndication investment opportunities? Like I said, my partners and I are in best and final on a 216 unit in Atlanta. So we should hear back probably the end of the week or next week if we got that contract, but it's looking favorable. So we're excited about that. Right now, pro forma, we got to take another look at it, but it's looking about, that 18 to 20% annualized return for investors. So that's looking like a really good Class B opportunity that's well below market rent, significantly, like $300-400 below market rent. So, and of course, Atlanta is one of the top markets to invest in the country. So really excited about that. What else? All right, doesn't look like too many questions coming in. There may be some in this Q&A. Sorry, I was looking in the chat box. When are we going on a bike ride? Anytime, man. I took a fall last week, though. I think I cracked a rib. So I've been taking it easy, but it's feeling a little better. Cool. What pressure does the late or delinquent rent payments have on the price of multifamily properties, and is it temporary? So, yeah, I mean, if you're looking at properties and there's a lot of delinquent rent payments, then that does weaken. I think so far we haven't seen a lot of price movement because generally they're still performing assets, right? So it's really difficult to price in the risk going forward from this whole pandemic, because owners are saying, hey, this property is performing. Why would I give it a discount? But of course, buyers want a discount because the risk is higher, right? So the price discovery has been pretty tight, the movement. But I think if we see additional weakness going forward, especially if it's a clear trend, then yeah, we could see some price declines. I don't think it's going to be drastic, but you never know. Any thoughts on micro hotels with STR potential? I'm speaking more on traditional hotels. I don't know if you're talking about like Airbnb or that type of thing. I mean, there's probably opportunity in both, right? I think there's a lot of Airbnb operators that got a long-term tenant in when this whole thing started. I don't have any data on that. That's just sort of anecdotal, but I think there's an opportunity there for sure. I think if I'm going to look at hotels, I would want to look in, near airports or in cores, the prime location. Those are the ones that are going to come back first, right? So, but yeah, I think there's great opportunity there. So self-storage, I haven't looked at the data for this month. So I don't want to speak on that because it would just be me guessing, but generally that has a very favorable reputation for sure, but it's just not something that I've spent a lot of time looking into as of late. Is the Atlanta investment still open? Yeah, so like I said, we haven't officially got it under contract. We're in best and final, but we're pretty hopeful it's looking good on our end. So if people are interested in that, just let me know, because if I don't hear from people until it's too late, then I can't get people on the list. So it helps just to touch base, give an idea of what you're looking to make for a soft commitment. Obviously, if nothing's binding, but that helps us reach out to you when the time comes. Also, recently, I don't know if you guys saw, Open Door was acquired. So this is one of the iBuyers, and it was acquired, I think, about a $5 billion purchase price or something. But it was just really, really interesting interview with the new owner, I guess. His name, I can't pronounce his name, so I'm not even gonna try. But just look that up. Look up Open Door and read into the acquisition a little bit. And I think, the guy makes a really good case for why that's sort of the future of real estate. So that's a bit of a different, they're going to IPO soon. So there could be an opportunity there. Obviously, that's a different type of investment, but I just thought it was interesting. This guy was really bullish on bringing technology into real estate. So I just thought I'd throw that up. Sort of a big news item of late. So cool. Do I have a resource for checking if an area allows in-law units? I heard regulations regarding these are being loosened. It depends where you are at. You're in your California markets. That's certainly a big one right now, is the accessory dwelling units, what they're called. So there's state ordinances that will supersede the local ordinances to get those through. So I'm not an expert on that. You'd have to reach out to someone that has done it in your particular market. So am I a cap or GM? You mean gross multiple? Is that where you're? Both? Neither? It depends. There's a lot more that goes into it than that, right? So, I mean, the cap rate is good to know. It helps you with some of your assumptions and your projections, looking at that market cap rate. But at the end of the day, it's all about what are the returns of the property, and do they meet your criteria? So. Cool. All right. Anything else? I think that's it. Cool. All right. Well, I think we'll end it there. Thank you guys for attending, and hope to see you next week. Like I said, we're going to be talking about how to manage a rental property, how to track the expenses, and things of that nature. And there's going to be a free spreadsheet with that as well. So make sure you sign up for that. I send out the replay to everyone that signs up, and I'll send out the spreadsheet ahead of time to everyone that signs up as well, so that you can follow along as I go through it and kind of show you how to do that. And yeah, tell your friends, like, comment, and share. All right. That's the new mantra: like, comment, and share. So spread the word. All right. Cheers, guys. Thanks.